Well, thanks, Blake. Blake and his team, communications and outreach team, always do a great job. They were here this morning at 7 a.m. and I was still in bed asleep. So I thank them for all they do to put this thing together. I also want to thank Judy Tang. Judy, you want to stand up? She's my economic analyst that works with me, put together almost all these slides. So basically I don't do anything, but I do get a lot of help and I appreciate that. I want to thank you all for coming here. A lot of familiar faces, and I appreciate you coming and sitting through this thing again. Some of the staff here at the San Antonio branch were a little bit worried about what I might show up dressed in today, since my wife's been out of the country for a week. She's in New Zealand visiting with a friend, or a friend's family there in New Zealand. She's been sending me a lot of pictures, and the pictures have a lot of sheep. Apparently there's a lot of sheep in New Zealand. And this reminds me of a story of, everybody wakes for my joke. Reminds me of a story of an economist that was walking down a country road, and he came across this big flock of sheep. And so he approached the shepherd and he said, I bet you $100 for one of those sheep that I can tell you exactly how many sheep you have in your flock. And so the shepherd thought about it, and he knew he had a lot of sheep and they're well dispersed. And he said, okay, I'll take that bet. So the economist looks around, he kind of analyzes kind of how they're spread and how many might be out of view, and he turns to the shepherd and said, you have 236 sheep. And the shepherd was quite amazed, and he said, that's exactly correct. You win. So the economist picks up an animal, starts walking away, and the shepherd says, hey, wait a minute, I bet you $100 for that animal, I can tell what profession you're in. And the economist thinks, well, he's probably going to guess math or statistics, so he said, I'll take the bet. And so the shepherd says, I bet you're an economist. And wow, he was amazed. He said, how'd you know that? He said, well, put down my dog and I'll tell you. So economists have a reputation for kind of understanding the data but not really understanding the difference between a sheep and a dog. So I can tell you that our president, Rob Kaplan, wanted to make sure that wasn't the case, so he has us meet with a lot of business folks and our boards of directors who give us advice that we don't get from looking at the data. So anyway, my title this year is pretty weak, expansion likely to continue. I don't put a lot of commitment there about kind of what growth is going to do, just that we're likely to continue to grow. It's been a very long expansion since, it's been something like 10 years since 2009, and it's the longest expansion in U.S. history. Texas, not so much. Texas actually had a longer expansion from the mid-'80s all the way to 2000. But it certainly is a very long expansion, and once you get into this type of length, people begin to get worried that the good times have to end pretty soon. And I can say last year in August and September, when the yield curve inverted, there was a lot of concern about that the party's about to end. But there was response by policymakers, both from the monetary policy and fiscal policy, that seems to have calmed things down, and the yield curve uninverted, became upward sloping. I'm a big follower of the yield curve, and I'll talk about that. But anyway, so the U.S. economy now seems on track to continue the expansion through this year, and that's really important for Texas. And Texas, once again, is also likely to continue. I'm going to start first with a brief discussion of the national economy. Texas economy is as you know, well integrated in the U.S. economy. We like to think we're our own country, but we are very integrated. If oil prices don't swing a lot, Texas is going to follow the national pattern. except for slightly stronger than the nation. So what happens nationally is important. And last year we had continued solid growth in the economy, but somewhat slower than in 2018. Both job growth and GDP growth slowed slightly last year. Actually, most people expected a little bit more of a slowdown because of the tax cut stimulus in 2018 that would die off a little bit in 2019. But overall, so GDP only slowed from 2.5 to 2.3. Employment growth slowed from 1.8 to 1.3. Manufacturing, construction, and mining, what we call the goods-producing sectors, slowed the last year while services continue to grow at a strong pace. The labor market remains what economists call full employment. Job growth, the unemployment rate ended the year at 3.5%. I got to not walk away from the microphone since this is being recorded. I like to move around a lot. About 3.5%. Most measures suggest that kind of full employment, or the natural rate of unemployment, is around 4.1 to 4.4. That means there's upward pressure on inflation once you get below that. We've sustained the unemployment rate below that, and surprisingly, inflation has not picked up. Inflation, by measures of a broad kind of underlying rate of inflation, has been very stable near the target of 2%, and I'll show you that. Toward the end of the year, while manufacturing slowed quite a bit, we came into the year, though, with some very positive news of trade that the USMCA passed, and we had this first stage of the China trade deal go through, and that's reduced some uncertainty. Early measures this year, manufacturing show some pickup, which is good news kind of going forward. As I mentioned, the negative yield spread occurred in August and September of last year, and more recent declines in the U.S. leading index still suggest some concern about the outlook for this year. But overall, forecasters are predicting that GDP growth will be positive, the expansion will continue, and GDP growth will be somewhere between 1.8 and 2.2, so just slightly below last year's pace. So this is job growth monthly. We like to cram a lot of data into one chart. And you can see the big declines during the Great Recession, but a long period of job expansion after that. I have these lines on here. 200,000 was what we used to say is a good month of job growth. But now with demographic shifts and the slowing of labor force growth as people age out of the labor force, it's more like 60 to 120 is a good number. You can see consistently higher numbers than that. Generally, that means the unemployment rate is going to continue to fall. And it's likely that it might fall slightly more this year. So labor markets will continue to be tight and get even tighter nationally. You can see here the unemployment rate was at 3.5%. That's the lowest in 50 years. I mean, we say that kind of casually, but it's pretty important. And I think about when I'm running my models, what does that mean? What does it mean when there's layoffs in one industry? How does that affect the total when maybe those people have a lot of opportunities to be hired elsewhere? So when you get to historically low rates, models aren't used to that. They're not used to kind of the extremes. And so it's very interesting when we get to a point in time like this where the unemployment rate is so very low. A lot of people bring up the U6 that, well, maybe 3.5 is very low, but if you take into account discouraged workers that are working part-time, that want to work full-time, that number is a lot higher. It's at 6.7%. But that number is also the lowest that we've ever measured. The measurement of the U6 started in the mid-90s, and it's the lowest right now than it's ever been. So most of you out there in the business world know that labor markets are extremely tight. It's very difficult to find workers across almost all skill levels. So nationally, if you look at the inflation rates, surprisingly, inflation has not accelerated. If you look at throughout much of 2019, we at the Dallas Fed use this measure called the trim mean, PCE. PCE is personal consumption expenditures. It's a broader measure than the CPI. And what a guy at the Dallas Fed, Jim Domas, does, instead of just looking at minus food and energy. He trims out every month the highs and the lows to get some underlying rate of inflation. The Fed can't respond to like shocks due to oil price swings or other temporary price swings. So this core measure's at 2. Now the overall PCE's been growing less than that at about 1.5% year over year. But the core being at 2 suggests that measure, the overall measure of prices is probably going to rise somewhat this year and move toward that 2%. Since it's kind of an underlying measure, it's kind of a forecast for the overall inflation. So we expect the forecast for the trim mean is 1.9% this year from the Dallas Fed, and that's essentially the same forecast for overall inflation, about 1.9%. So another year of sticking close to that 2% level. So I mentioned the yield curve. A lot of you've heard about the yield curve. If you've never heard about the yield curve, you probably heard about it last year. And you can see that well, you can't really tell months. This is a chart all the way back to 1955, and these shaded bars are recessions. And this is just the yield on the 10-year Treasury minus the yield on the 1-year Treasury. Normally, 10-year yield is higher because there's a risk premium and the economy is expected to grow. Long rates are higher than short rates, they're riskier. But when short rates get higher than long rates, specifically this is a 10-year, 1-year spread, that's an ominous sign for the future. And you can see there was only one false signal of this, and that was in the mid-60s, where GDP growth went from about 4% to about 0.5% over 2 quarters. So it was close to a recession. And you can see that before the Great Recession in 2008, 2009, the yield curve went quite steeply negative and stayed there for a while. And this was a year in advance of the recession. So you know, and if you go back to the news reports, there's a lot of people saying why the yield curve wouldn't work this time or why it's different this time because globalization of financial markets, blah, blah, blah. And I've mentioned this before, that the reason why people kind of shoo off the yield curve is because a year before the recession, everything else is positive. The economy looks great. Consumer spending is strong. The U.S. leading index is going up. Just about everything in the economy is strong except for the yield curve, so it's easy to kind of come up with reasons why it's not that important to look at this time. So this time is different. The yield curve went only slightly negative for 2 months. And then, you know, the Fed cut rates and the trade war started to ease off. A lot of the reason why long rates fell during the year a lot of times after these tariffs were announced. And so it's the market responding to expectations about the future, and that's exactly why you should be concerned about the yield curve. But anyway, so you look back, and I look back and say, well, what period in time does it look like similar to what we just saw if, in fact, the yield curve stays positive? We actually, yesterday, the spread was only 9 basis points. You see in December, it was 31. This is monthly. And that's because of the coronavirus. People are very worried about the outlook because of the coronavirus. But I assume this yield spread on a monthly basis will remain positive. If you look back on kind of market reactions to, say, the SARS virus and Ebola, it was about a 1-month correction and then things bounce back. That's assuming that this thing is contained, like the other two were. So nonetheless, if you look back, before the 90-91 recession, there was a mild inversion of the yield curve, but it lasted 7 months, and it was a little bit steeper than what we have. So essentially what I think out of this signal is that it's still cautionary because we've never seen like just a slight 2-month decline in the yield curve followed by positive yield spreads after. But if you look at any of the models, they suggest a declining probability of recession since October, somewhere between, say, 25 and 40% now. So anyway, so I think it's an unusual thing. I think it's a good thing that policy responded, and maybe we can avert this thing. But we'll see going forward. It's something to be raises the uncertainty around the forecast, I think. The U.S. leading index actually has turned quite negative toward the end of the year. This is a 6-month and 12-month change in the U.S. leading index. The 6-month turns slightly negative, but the blue one is really the one that you have to be worried about if it goes negative. It was still positive in December, but slightly. You can see there's been other points in time where this leading index got close to the zero line here back in 2015 and 16 when oil prices collapsed and the manufacturing sector got hit by the energy sector. You can see, and we had no recession there. So it's not forecasting recession, but it is forecasting somewhat weaker growth over the next 3 to 6 months. It's a short-term type of forecast. So there is some caution there about a little bit slower growth. If you look at the blue chip, which is an average of 50 forecasters across the U.S., they're expecting, once again, 1.8. In my original slide, I put 1.8 to 2.2. 2.2 is the Dallas Fed. They're a little more optimistic than other forecasters. So that's the U.S. economy. That means that's a good news for the Texas economy, that this yield curve did not keep steepening, did not keep going negative and getting more negative as we went through the end of last year. That, in fact, reversed course. And the U.S. economy is likely to continue its expansion. That's good news for Texas. Texas is more dependent on the national economy than it is on oil prices, but when oil prices swing, it affects our relative performance to the U.S. economy. In 2015 and 16, oil prices collapsed, and Texas grew below the national average in terms of job growth for the first time in 13 years. It continued to expand. There are a lot of question marks from people about if Texas could continue to expand during this big collapse in oil prices back in 15 and 16, but we did. And part of that was continuing growth in the national economy. But so we had these weak years in 15 and 16, and then Texas picked up in 2017 and 18. And last year, oil prices fell again. They didn't collapse. Usually they'll go from 100 to 40. This time they went from about 80 to 50 to 60, although at this point last year it had gone down below 50. And hence my 2 week of a forecast for this year. But anyway, so last year, energy sector weakened and Texas weakened. The economy weakened slightly. But we saw most of the weakening occur in the first half of the year as oil prices stabilized in the $50 to $60 range. We saw some of those declines dissipate, and we saw pickup in job growth in the second half of the year. And in the fourth quarter, we saw a pickup in the Texas leading index, suggesting that we'll have pretty good growth in the economy this year. We hope that trade uncertainty is going to be less of a negative factor. Texas is the #1 exporting state in the nation, and tariffs have a big impact on our economy, although actually our exports were not as negatively affected last year because we have less exposure to China than the national average. People who export into China got the biggest hit. Election uncertainty is likely to constrain growth, both not growth overall, but business investment. It always does in an election year. And that's one of the things that has been dragging GDP growth. Consumers remain very strong. As you've heard before, consumer spending can be 75% of the economy. Consumers remain strong and actually in pretty good financial shape, and that's some of the most positive news we have. But business investment has been weak, and while trade uncertainty should help that, election uncertainty is going to likely continue to suppress that. But overall, if you want to just eat your lunch and not pay attention to anything else, the forecast is that I think it's going to be pretty steady job growth. last year we had 2%. My model says 2.1, pretty much the same as last year. I will hedge it by saying that a big factor is this tight labor markets. That if labor markets weren't below full employment right now, we'd really have, I would think last year and the year before, have job growth near 3%. Long-term average job growth is 2.1, and we're right about average. So it sounds like, well, it's an average year, but it's really much stronger than average. It's just jobs can't grow if you don't have workers. And so it's really been a strong year with historically tight labor markets. It was last year and will continue to be this year. And job growth will continue to be constrained by labor markets. So if you look at, how long have I been talking? So if you look at job growth, this is since the mid-90s for Texas and the U.S. Texas is the black bars and U.S. is the red bars. If you go to these every year, I mention the same thing, that Texas, that the steady state or the expectation is for Texas to grow faster than the U.S. On average, since 1990, we grow about 2.1% a year, and the U.S. grows about 1.1% a year. So we do grow average. And this isn't about oil prices. I'm speaking a lot about energy impacts this year because the energy industry has been swinging a lot. But if you look at the 90s, the oil and gas sector was generally just on a slow decline. They had very little impact on the Texas economy, and yet the Texas economy did much better than the national average. So overall, over the long term, what causes growth here is that we have a lower cost of living, lower cost of doing business, and that attracts businesses to the state, and we tend to grow faster. But if oil prices swing either way up or way down, it's going to affect how we grow relative to the national average. And you can see in 2015 and 16, we dipped below the national average as oil prices collapsed. And then as oil prices improved, we grew above the national average once again. And then last year, as oil prices weakened, we weakened, but so did the national economy. We both weakened by about 0.4% job growth, but we still remain above the national average because last year wasn't a collapse in oil prices. It was a weakening of oil prices to kind of a range where some producers can still make money by drilling and others producers can't. So there was a decline in the rig count, but not a collapse in the rig count. So I throw this thing in this. I have a business cycle index that helps define recessions in Texas, and it steps away from just looking at job growth. While job growth is like about an average, long-term average, the business cycle index suggests what I said before, that actual economic activity is above average and above the long-term trend. And you can see we've been in this long, as I mentioned before, long expansion, but we had a really long expansion in 87 to 2001, and so the U.S. had a recession in 90-91, a mild recession that was a Gulf War, that oil prices were driven up, and Texas slowed quite a bit, but you can see we didn't go below the line, so we had a very long expansion there. But this expansion here is likely to continue, and it's at a healthy pace. The unemployment rate is at 3.5% in December. We spent most of the year at 3.4% from June to November. That was the lowest ever recorded. The unemployment rate, consistently measured unemployment rate, goes back to the mid-1970s in Texas, and we've never had it this low. And all those oil price booms that we had in the 70s and 80s, the unemployment rate never got this low. And part of the reason is because those were when oil prices went way up, and so people from across the country came to Texas. In fact, I was one of them. In the early 80s, when I got my undergraduate degree in the Midwest and the U.S. was in a recession, I interviewed at the Houston Post for a job as a copy editor. I did not get that job. So I went to grad school, so the story had a happy ending. But everyone, historically, Texas has done really well because of oil prices, and when oil prices were really high, the U.S. did worse, so people were looking for jobs and came to Texas. Now, this story is different, 2019, because things are really good here, but they're really good everywhere else. The unemployment rate in the U.S. is the same as Texas. So while net domestic migration into Texas has been strong, and the latest measures from July of 18 to July of 19 were actually picked up, I think going forward it's going to be harder and harder to attract people, simply because people don't want to move. People want to stay near their families and their churches and their communities. And when they're not being laid off other places, they're not looking for a good place to move. So we'll still see net positive migration into Texas this year, but I don't think it's going to be as strong as last year and the year before. It kind of dies down, not because we're not a great place to be, but because they're not being laid off. And if they do get laid off, there's opportunity in their surrounding community. So things are really tight. I think the labor market here in Texas will continue to tighten, and we're going to set new records for the unemployment rate this year. If you look at job growth across regions, you can see here, as I showed, Texas slowed from 2.4 to 2.0 last year. The slowing occurred primarily in the Houston economy. The Houston economy went from very strong 2.6 to 1.6. 1.6 is still good. If you look at the employment data for the oil and gas sector, it's almost all in service companies. Those are drilling companies. Those jobs are in West Texas. It's the oil and gas companies themselves that are primarily in Houston that actually didn't decline last year. The employment in these what I call more white-collar jobs in the oil and gas sector declined in 2015, and 16 never bounced back. And so they were pretty lean going into this energy cycle, and so we haven't seen those declines. So Houston has held up quite well, even though the energy sector is weak, but still some slowing in the Houston economy. Dallas and Austin remained very strong last year, really didn't change job growth. Fort Worth picked up slightly, and San Antonio actually picked up the most. Now, it's really interesting, and we have a slide. I have a slide on San Antonio, since most of you are from San Antonio, and I think it's a labor force story there in San Antonio that, and I'll talk about it a little bit more. But San Antonio job growth last year was 2.2%, pretty good growth, and faster than the year before. If you look at the job growth by industry, you see a similar story as job growth by MSA, that the weakness was really centered in the oil and gas sector. All these other industries were positive job growth, with the exception, as I said, of oil and gas last year. And I do note that one particular strength was the construction sector. Despite very tight markets and hearing a lot from our contacts about difficulty finding workers, construction jobs picked up to 5.2% last year, a very strong pace of growth. Some of that may have come from the oil and gas sector. We're trying to figure that out. There is some convertibility of skills from the energy sector to the construction sector. So some of those jobs may have moved there. I know here in San Antonio, I think we benefited from some of the winding down of construction projects along the coast. I think there are construction workers that left to rebuild from Harvey. But nonetheless, construction was strong, as the housing sector was really strong last year, and that was a source of strength. But if you look across industries, you see positive job growth, once again with the exception of the energy sector. We have our surveys that we do of businesses. Once again, we try to make sure we don't mistake a sheep for a dog. And we talk to a lot of businesses, and we have our surveys. We have a Texas service sector survey and a manufacturing survey. And you can see the dotted lines are kind of the average. For services, we ask them about, has your revenue increased, stayed the same, or decreased? And this is net increase. And you can see that the service sector picked up toward the end of the year and was above long-term average, whereas manufacturing saw a weakening in the second half. And that may be because the energy sector weakened primarily in the second quarter, and then the demand for, say, oil and gas field equipment and other things we produce a lot followed through in the third and fourth quarter. But overall, you see that, so since the line in manufacturing was still positive, it still meant that production was growing just at a slower pace. And we saw a little bit of pickup here in January. So that's another thing about our surveys. It's more timely than our jobs data. We don't have jobs data for January, but we do have our contacts from the services. And we saw some pickup in manufacturing, a slight tick up in January. One of the things that affected our manufacturing sector last year and our service sector was the tariffs that were put on, both in terms of our imports and retaliatory tariffs on our exports. We asked our manufacturers in the middle of last year, what impact have U.S. and foreign tariffs implemented since last year had on the following aspects of your business? And you can see that, so here manufacturing is blue and services are green, and you can see that rising input costs, but selling price is rising, but not as much as input costs. And then so you can look all the way to the right and you see profit margins declining, and both in services and manufacturing, but more impact on manufacturing. So capital spending, negative. So these are net. Some manufacturers did report positive impacts of the tariffs, but a much smaller percentage than reported negative. So this was one of the drags on both in manufacturing, both in the U.S. and Texas. One of the things that have driven, as I mentioned, Texas is the biggest exporting state in the nation. One of the things that have driven exports here has been the energy sector. They lifted the ban on oil exports in 2015. You can see the big rise. This is energy and energy related. It includes petrochemicals and refined products such as diesel fuel, which we export a lot of to Latin America. And you can see that this orange line is energy-related exports. They're up some 65% over since 2016. And then total exports, and then exports less energy is the blue line, which have been fairly flat. But if you look at that blue line a little bit closer, you can, and compare it to the U.S., we've actually done better in non-energy related exports than the rest of the U.S. And we did have a tick up there in the second half of last year. And part of the reason, as I mentioned before, is we have less exposure to China in terms of amount of our exports that go there. So one of the big factors that was a positive last year was the construction sector. This green line is the 30-year mortgage rate. It fell from a full percentage point from October 2018 to August of 2019. And that stimulated a lot of building activity from, I think it was February of last year to December. Single-family housing permits in Texas grew about 20%, whereas existing home sales rose about 7%. And so a primary factor is the mortgage rate decline, although 10 years of expansion and a historically low unemployment rate mean that a lot of people have consistent job records that can qualify for home building. And we are seeing in our district, and in particular here in San Antonio, this new rise in affordable housing. Builders looking into this market for trying to build homes for less than $200,000. We're seeing quite a big develop in that. Eduardo back there just bought one, didn't you, Eduardo? Yes, say yes. Okay, so so this has resulted in very strong home building, and I think that level of building activity will be maintained. The growth rate will not. Mortgage rates have kind of bottomed out and flattened out, which means as the mortgage rate drops, more and more people qualify for a given home, and then it levels out. So even though it's level and it's low, it means that the building activity will remain high but not increase as much as it did last year. We won't see another 20% increase in homes and building permits, but it'll still be another good year for home building. Oil prices suggest that the rig count is likely to flatten out. You can see this is the oil price. I shifted forward 3 months because it leads the rig count by about 3 months. Rigs are those drilling for new oil and gas resources. You're starting to see sort of a flattening out. I gave this presentation in Dallas. One of our board members who's in the energy sector kind of was trying to describe the sheep and the dog thing, because one of the things that might drive the rig count down is separate from oil prices, and it's this kind of suddenly it's out of fashion to invest in oil and gas companies, and we've seen a big rise in spreads between high-yield bonds and energy versus high-yield bonds outside of energy. And this has put a dampening on capital investment in energy as firms are having a hard time raising money. I don't know how long this will last. This could have been a quick adjustment, but anyway, the energy sector is likely to flatten out somewhat, but I think it'll still be a slight drag on the Texas economy. But the change from last year to this year will be less dramatic than the change in the drilling activity from 2018 to 2019. How am I doing on time, Blake? What do I got?
You're good.
You good? When am I supposed to stop?
125.
Oh, really? Oh, I can relax now. Okay. So if we look at the energy sector, which has been a source of kind of volatility in Texas economy in recent years, our survey, we do this energy survey. It's the largest, the Dallas Fed does the largest energy survey in the state. And we ask producers, what are your break-even? This is break-even for new drilling. What price do you need to profitably drill a new well? And you can see within, across basins here in the U.S., that it varies quite a bit. But the average is somewhere around 48 to 54 across these basins. Currently, the price, well, we have 56. I think it's more like 51 or 2 this morning. So we're still above the average, but it's suggesting a lot of producers in some of in the basins will not have a high enough price to drill. So at that price of 51 or 52, we're going to see kind of continued weakness in the energy sector. Now, our survey suggests that the producers expect oil prices to finish year around 58. 58 is better than where they're at right now, but 58 is still kind of suggests weak drilling activity in the energy sector. So overall, I expect the energy sector to be a slightly negative drag on the state, but you know, generally mostly neutral in terms of growth from last year to growth to this year. You can see that producers in the fourth quarter last year reported declines in business activity, declines in employment, slight uptick in output. It went from slightly, so that question on the outlook is, has your outlook improved, stayed the same, or gotten worse? And so this is a number of respondents saying improved versus gotten worse. And it's just slightly above 0. So basically it says about half of them said that outlook has improved and half say it's gotten worse. So it's pretty kind of in that neutral zone. Uncertainty has fallen a little bit, still remains pretty high. So this is a chart I really like. This is oil prices adjusted for inflation is this red line. This goes all the way back to 1982. Now, oil prices are tricky because, as I said, the Texas economy is dependent on the national economy and factors that affect the national economy, like the interest rate and inflation and things like that. But this top line isn't Texas job growth, it's the Texas advantage. It's Texas minus U.S. job growth. So you can see, like I showed in the other chart, Texas usually does grow faster, so that's above 0. When it dips below 0, doesn't mean we're declining, it just means we're growing less fast than the nation, or slower than the nation. And you can see back in 2015 and 16, when oil prices fell sharply, Texas grew below the nation. You see that gray line dip below the zero line. And then as we come back up, you see that we're growing above the nation again. And you can see that oil prices flattened out after dipping at the end of falling quite sharply in the fourth quarter of 2018, and then bouncing back in the first quarter of 19, and then kind of stabilizing for the rest of the year in this kind of $50 to $60 range that we've been growing above the national average. This thing has shifted forward 6 months. That means that the oil price will lead our relative growth by about 6 months. So when oil prices swing, we don't immediately change our relative growth. It takes a while. So by shifting it forward 6 months, it essentially represents a forecast of what we're likely to do relative to the nation over the first 6 months of this year. And just by visual look, it's going sideways, so that we'll likely maintain close to what we did last year in terms of our relative growth relative to the nation. So I think this is a really interesting chart. As I said, some energy experts suggest that if price isn't leading this, maybe this won't hold up as well. But this thing is held up through a lot of changes in the oil and gas sector, a lot of productivity increases in oil and gas. It still seems to be very reflective. So this doesn't tell you everything. It doesn't forecast what job growth will be. It'll forecast how job growth will be relative to the nation. And if the nation is expected to grow, we should grow faster than that. And that's consistent with my forecast. If you look at outlooks from people that we survey in our manufacturing a survey, as Blake mentioned, a lot of our survey respondents are in this room. We ask, has your outlook improved, stayed the same, or gotten worse? This number here is the percentage of respondents that say improved minus the percentage of respondents say it got worse. And you can see here that the blue line is the service sector, and outlooks have been improving in the service sector companies, whereas in manufacturing they've been improving but not improving as much. So it's above zero, so there's still slightly more to say that their outlook's improved than say it's gotten worse, but pretty much close to equal amount. So there hasn't been a big pickup in the outlook for manufacturers. But there has been in services, private service companies represent about 60 to 70% of all jobs in the state. So they're a much bigger job producer than the manufacturing sector. If you look at my leading index that I do, it's similar to the U.S. leading index. Things that tend to lead big changes in the Texas economy. Texas stock prices of companies based in Texas, oil prices, well permits, help wanted advertising, average weekly hours in manufacturing. And I have the U.S. leading index here because certainly movements in the U.S. economy are important to Texas, and it basically aggregates macro series together, and an initial unemployment claims. And you can see over the past 3 months, through December, most of these things have been positive, although there's a few that are negative. And overall, the leading index has been increasing, suggesting improved growth over the next 3 to 6 months. And you can see overall, though, this red line is the index. It's not been moving significantly in either direction, kind of suggesting pretty similar growth. And actually, the forecast suggests 2.1 versus 2 last year, so pretty similar. So if I look at San Antonio's economy, job growth actually picked up last year to 2.2 after 1.6 the previous year. The federal government, which is it's hard to measure federal government influence on San Antonio. So we look at federal government employment as a proxy, but a lot of the government goes through spending and contracts to private sector employers. But nonetheless, federal government's been pretty weak, but construction, healthcare, and leisure and hospitality has been strong. If you look at, I told you I'd mentioned San Antonio, and so I'm going to do it here. This blue line here is total jobs. And I added some industries in here that tend to be core industries in San Antonio: healthcare, leisure and hospitality, and the federal government. But this blue bar here, if you look at 2015 and 16, overall job growth in San Antonio was quite strong. And I thought that was interesting. Those were the years of oil price declines. When the energy sector weakened the state economy a lot, San Antonio did well. And then when the energy sector came back in 2017 and 18, San Antonio weakened. And then the energy sector weakened in 2019 and San Antonio picked up. So it's kind of this weird kind of negative correlation with oil and gas. Now we know the Eagle Ford is directly south of us. And when the Eagle Ford first started booming, we thought San Antonio might become more energy dependent, right? And I don't think that's the case very much. Now we do have oil and gas jobs and they've been declining this year. But I think what's happened is when the oil and gas sector has boomed, it's drained it's drained some of our employers down out of San Antonio. And our manufacturers here have told me that. When the Eagle Ford first boomed, a lot of truck drivers and other people working manufacturing were attracted down into the Eagle Ford. And maybe as that sector weakened, some of these jobs came back here. And what was particularly strong in San Antonio last year was construction jobs. I don't have it on here, but it was very strong growth in construction. And some of that, I think, was some maybe energy workers. But I also think, as I mentioned earlier, that there were newspaper reports about construction companies having to turn down jobs because they didn't have enough workers. And I think the workers coming back from rebuilding from Harvey helped our construction sector to move forward. It's also the case that our housing sector has been very strong. So you put these factors together, we're doing quite well. We've had, retail has been flat, and retail was really hurt at the first half of last year because of the crisis at the border. During Easter week, Semana Santa, we had a lot less traffic than normal because of the congestion at the border. And retail overall is going through a transition with more and more online shopping. There's less and less brick and mortar retail, and San Antonio as a tourist town has quite a bit of retail. But anyway, retail was somewhat weak, but overall, once again, job growth picked up to 2.2, faster than the state. Long-term, San Antonio, that's about what we do on average. We grow slightly above the state average. I've mentioned this before, and you know it. The great thing about San Antonio is not its super fast growth rate; it's its volatility being low. We're a great place to be in a recession, right? During boom times, like the last several years, we're not as strong as Austin, but during recessions, we're not as weak as Austin. We just don't swing as much given our dependence on healthcare, government, things like that, which are much more stable. Okay, so now that I've put you to sleep, I'll give you a summary. So the national economy slowed slightly last year, not as much as a lot of people expected, given the kind of the dampening of the stimulus from the tax cuts. But 19 was a good year. Historically low unemployment rates in the U.S., continued growth. We hit this kind of inversion of the yield curve, expectation that the U.S. economy might be entering a recession sometime this year or early next year, but that yield curve changed its mind, mostly in response to policy changes, both monetary and fiscal. And so now it looks more likely that there will not be a recession than there will be, and most forecasters are expecting just slightly weaker slightly weaker output and job growth than last year. Historically tight labor markets continue to restrain job growth both here and in the nation, throughout the nation. Texas jobs grew 2% last year. And will likely grow about that same pace. I mean, there's really, in a forecast sense, no difference between 2 and 2.1. There are, I think, greater downside risks and upside risk. I think the unemployment rate, despite being at the very lowest level we've ever measured, besides December, at 3.4, is likely to decline even further, maybe tick down to maybe 3.1 or something like that. The biggest downside risk to the forecast, there's always a risk of oil price decline. Even though we think we know about the balance between supply and demand and this and that and who's producing and who's not, we never predict these big swings in oil prices. So there's a lot of uncertainty there. Obviously, oil prices could go up too, and then we'd be stronger than my forecast suggests. Trade war seems to be winding down, but that could change. And then the there is some chance of a national recession. I don't think it's very large, but obviously if the nation went into recession, Texas would follow, unless it was caused by oil prices going to $100 a barrel. I might mention the oil price. I think I've shown this before. This is the forecast. The red line is the short-term energy outlook forecast from the Energy Information Agency. The green line is the futures prices, what the future prices suggest. The red line suggests the 59 and the green line 57. Our respondent said 58. So it looks all nice and tight there, but if you look at the 95% confidence band, it's somewhere between $30 and $90. So that suggests a lot of uncertainty about oil prices, and we're never going to figure out how to do that. So as Blake mentioned, I look at how I did from last year. So I took this bullet point from the summary slide. Texas expected to have grown 2.4% in 2018 and will slow to about 1.4% in 2019. So instead, growth slowed from 2.4 to 2.0. So I was too weak in my forecast. And I can show you that if you look at this chart, if you look at 2019, early 2019, oil prices had just dropped below $50 a barrel. And you could take those red and green lines and just extend them from there, because that's usually what the forecast suggests, is that we're not going to have any difference. And so actually oil prices were quite a bit higher than it was expected in January of last year. And that's one of the reasons probably why my forecast was off by 0.6%, which makes me quite sad. Although I'm quite happy the economy was stronger than I forecast. So, but anyway, as I mentioned, the forecast changes throughout the year as shocks occur. If oil prices jump to 100, this forecast is not going to look good. If they go to 40, it's not going to look good. If there's some big war in the Middle East, it's not going to look good. Things can change constantly. So we do publish a monthly forecast on our webpage that I update my model every month as new information comes in. So you can get, as soon as the employment data is released every month, we release a new forecast. So you can follow along through the year and see how the forecast changes based on new information. We also have a lot of other stuff on our website that we'd be happy for you to look at. And I think that's it. So that's all I have formally, so we can take Q&A now.
I would be remiss if I didn't ask you a question, Professor Phillips. So I'm going to give you a red herring.
All right.
The slides are great, by the way. I love those slides.
Oh, well, thank you.
Talk to those. There was a story about a year ago, a negative interest rate that didn't have a whole lot of legs here in the U.S., but there was some talk about a negative interest rate in Europe. I don't know if you heard about that. Could you just tell me what that would mean?
Certainly, there was a lot of things being traded at negative interest rates in Europe last year. Primarily, though, it was central bank interest rates, where you pay a negative yield on excess reserves, just to encourage lending by banks rather than to park money at the central bank. But there were other negative interest rates out there. But negative interest rate is a sign, well, first of all, it can't be very widespread. People just hold money in cash where you get zero, and zero is better than negative. I mean, that's common sense. But if you're a bank and you have to hold certain liquidities, you can take negative interest rates temporarily. So there's some reasons why some institutions would hold debt at negative, but in general it wouldn't be widespread. But negative interest rates in general are a sign of something's gone wrong. It's a sign that you're panicked or you're in very desperate need of stimulating the economy. The Fed obviously would not want to be in that situation, and I don't think we're anywhere close to that right now. So negative interest rates are an odd thing. They have occurred, and during the financial crisis they occurred because yields dropped as people bought up government securities because they were panicked, and they would buy them even if the yield was negative. But once again, that's a sign of a crisis or a panic situation. So I don't perceive any issue with that in the U.S. for any time soon. Former EMBA student at UTSA.
Thanks for the great talk for being in USA. What do you think about asset bubbles? And, certainly we saw them in '07 leading into the crisis, but, they're starting to, at least in my opinion, they're starting to rear their ugly head. How do you think that's going to play out internationally?
Yeah, so economists always have trouble with bubbles because we start with the principle of market efficiency. Well, I don't know what I should say on this, but our bank president, Rob Kaplan, has been talking in the media and concerned about the Fed intervening in sharp markets and if it's having an effect on asset prices. There's debate if it's considered any form of QE or not. Essentially, we set a target for the Fed funds rate, and if there's not enough liquidity to support a low rate, the rate starts to jump. And if it does, you have to intervene and bring the rate down into your target range. That's not QE. QE is trying to affect the long end of the market by buying longer-term securities. But anyway, asset prices should be supported by earnings reports, right? In theory, the price of a stock is equal to the net present value of future earnings. And that can be affected by, earnings or interest rates. And so certainly there was reason during the second half of the year to maybe, after the yield curve became no longer inverted, to have a more optimistic view of the economy, which means a more optimistic view of stock prices in the future, or earnings in the future. And that can drive your expectations of prices to go higher. So there are certainly economic reasons why stocks finished the year strong, and some trade developments that were more positive. Was it the balance sheet thing with the Fed and the repo markets being a major influence on stock prices? I don't know. I think a lot of people are looking into that question and a lot of debate about that. But there are good reasons why the view of the economy improved in the fourth quarter as the yield curve remained positive, upward sloping, and the trade war died down somewhat, that you would expect that the performance of companies to improve. Pretty diplomatic, right? Yes.
So I appreciated your poking a little fun at models and about how they work and don't work, particularly as things get to those extremes.
So wait a minute, poking fun at what?
Models.
Oh, models, yes.
Right? And so the Fed, first with Chair Yellen, and I think even more interestingly under Chairman Powell, has been very patient about whether to make moves in monetary policy while watching wages.
real price pressures as opposed to supposed price pressures. And I think that's probably played a role in extending out our very long expansion. And so I'm wondering, the use of the word full employment and the idea of being below full employment harkens back to the economic model, right? And how useful is that, and how, to what extent do you feel, and there's lots of folks looking at this, but that there are ideas about that relationship between inflation and price pressures, and whether it's really low wage price pressures that are ones we should be looking for. Where are you in your thinking about those relationships and whether that be thrown things out?
So you an economist, or? Yeah, so does the Phillips curve, is that still useful, right? The relationship between unemployment and inflation, unemployment and wages. We have a lot of debate about that at the Dallas Fed. But we just had a presentation from one of our macro guys that if you adjust for certain things, first, if you measure inflation like through the trim mean and you make adjustments, some other adjustment, that the Phillips curve actually is fairly steady. But that's after you make, its relationship between certain measures of inflation and other adjustments. But you're right. I mean, I think we've been surprised that wages haven't been stronger and that inflation hasn't been higher, given the low level of the unemployment rate. There are other measures of wages that show much higher wage growth than, say, average hourly earnings. But they don't see much of a pickup last year. They're still quite flat. So the Atlanta Fed has this wage tracker, and it tracks people what their actual wage gain was from last year to this year if you're still in the market. So there's different factors that change wages. One is the aging of the workforce, and when you retire, a lot of people that are retiring generally are making higher wages than people coming in, and they're a bigger force. So it drags the wage growth down. It's also mathematically average hourly wages are just total wages divided by total hours. And if you think of that, that means that higher wage individuals are given a bigger weight. And higher wage individuals don't see wage growth as fast as lower wage because they're generally in their 40s and 50s, like me. I hardly ever see a wage increase. No, I'm just kidding. But so there's some technical details that when you iron it out, overall wage growth looks stronger. I think the Atlanta Fed wage tracker suggests that last year somewhere around 4.5% wage growth, which is much stronger than the hourly wage increase. So I think technically there's some ways to do it, but I do think it's surprising. And Rob Kaplan, our bank president, thinks that it's being driven downward from the fact that as more and more people shop on the internet and more businesses do business there, it's harder and harder to pass on price increases. It's very difficult to raise your prices in this environment. If you can't raise your prices, it's very difficult to raise your wages. And so there's all different factors that are going on in this regard. But wages, when you make adjustments, have been doing well, just as not as strong as people thought. And so you have to really kind of think about this Phillips curve relationship and do some adjustments before you can kind of think it's still valid. I don't know if that answers your questions. It sounds like a lot of mumble jumble to me, but that's all I know about that. One more question? Yeah, I must have explained things quite well. All right. Thank you very much.
Thank you, Keith. So thank you all again for attending. On your tables, we have comment cards. We'd love your feedback. If you are interested in getting more involved in the Dallas Fed, check the box at the bottom and notate that. Or if you'd like to get our publications and subscriptions, note that as well. For those of you online, this event's webpage has the the event evaluation form for you to do that online for us as well. With that, thank you again for taking time out of your busy days to join us, and we stand adjourned.